The IRS is deploying technology right now that simply did not exist 2 years ago. Technology specifically designed to detect errors on your tax return connected to your home. And if you are a homeowner over the age of 60, there is a very real possibility they have already flagged one of yours. That is not speculation. That is what happens when you give the IRS $80 billion in new funding and direct them to build a system that cross-references every county deed record, every mortgage lender report, every Airbnb payment, and every estate filing in the country against every tax return on file. That system is not coming. It is operational right now. It is identifying discrepancies. And the people it is flagging more than anyone else are seniors who own homes with substantial equity. I am going to walk you through exactly what the IRS is looking for, the 4 specific transactions that are triggering automatic flags on senior homeowners, and the 5 steps you need to take before May 19th to protect yourself. But first, I need to share something that most people do not fully understand about how this new system works. Because once you understand it, everything about how seriously you need to take the next few minutes changes completely. What shifted and why it matters now? For decades, the IRS operated under significant constraints, a limited budget, aging computer systems, insufficient staff to meaningfully verify whether what was on your tax return actually matched reality. Audit rates dropped to historic lows. Compliance gaps went undetected for years. Millions of Americans, many of them seniors, were making completely ordinary financial decisions involving their homes without ever being told those decisions carried specific tax reporting requirements. They added a child to the deed. They took out a home equity line of credit to cover medical expenses. They rented a spare bedroom through Airbnb. They inherited property from a spouse or a parent and simply continued living in it. Every single one of those actions can trigger a specific IRS reporting obligation, and for a long time, almost nobody got caught because the IRS simply did not have the tools to check. That era ended in 2022 and 2023. Congress authorized approximately $80 billion in new IRS funding through the Inflation Reduction Act. A substantial portion of that money went directly into enforcement infrastructure and technology. The IRS used it to build automated data matching systems that pull information from sources that had never been connected before. County property records, mortgage lenders, home equity loan servicers, title companies, short-term rental platforms like Airbnb and VRBO, estate and probate court filings. All of that data now flows into machine learning systems that compare it in real time against every tax return associated with the property owners involved. The system is not searching for suspicious behavior. It is performing mathematical comparisons, looking for discrepancies. A deed transfer with no corresponding Form 709, a 1099-K from Airbnb with no Schedule E on the return, a home equity loan with a claimed interest deduction that does not align with the loan's stated purpose, an inherited property sale with no documented cost basis. These are not judgment calls, they are automated calculations. And when the system finds a discrepancy, it generates a notice without any human being reviewing the file first. By the time that notice arrives in your mailbox, the analysis is already finished. The IRS is not asking whether a problem exists. They are informing you that they have already identified one. The 4 specific triggers. At least one of these likely applies to you. Trigger 1. Using a home equity loan or HELOC for anything other than home improvement. This has become extraordinarily common among seniors over the past several years. Inflation has driven up the cost of groceries, utilities, prescription medications, and basic everyday living. Millions of older Americans have turned to their home equity as a financial resource to bridge those gaps. Maybe you took out a HELOC to pay off credit card debt. Maybe you used the funds to help a grandchild with college tuition. Maybe you needed it for a medical procedure that insurance did not fully cover. Those are completely understandable decisions any reasonable person would make. But here is what your lender almost certainly never told you. Under current tax law, specifically the Tax Cuts and Jobs Act of 2017, which remains in effect, home equity loan interest is only deductible if the proceeds were used to buy, build, or substantially improve the home that secures the loan. IRS Publication 936 makes this explicit. If you use the money for anything else, medical bills, debt consolidation, tuition, living expenses, the interest is simply not deductible. Full stop. And if you or your tax preparer claimed that interest as a deduction on Schedule A of your return, you now have an incorrect deduction on file that the IRS can identify directly through their lender data matching systems. The financial consequences begin with the additional tax owed on the amount that should not have been deducted, then interest calculated from the original due date of the return, then a potential accuracy-related penalty of 20% of the total underpayment. For a senior living on a fixed income, that combination of back taxes, interest, and penalties can easily reach several $1,000s, from what felt like a routine financial decision made with no guidance whatsoever. Trigger 2. Adding a family member to your home's deed. This one catches more people completely off guard than almost anything else, because it is such a common thing that families do with genuinely good intentions. You add an adult son or daughter to the deed so the house passes to them automatically at your death without going through probate. Someone told you it would protect the property from Medicaid recovery. You simply wanted to make things easier for your family after you are gone. From a family planning perspective, those motivations make complete sense. From a tax perspective, what you did is something entirely different. Adding someone to your deed is not a simple administrative update. It is a transfer of a partial ownership interest in real estate, and the IRS treats that transfer as a gift. Under the Internal Revenue Code, the transfer of property by gift is a reportable and potentially taxable event when the value exceeds the annual gift tax exclusion. For 2026, that exclusion is $18,000 per recipient. If your home is worth $400,000 and you added your child as a 50% owner, you transferred $200,000 in value. That means you were required to file IRS Form 709, the United States Gift and Generation Skipping Transfer Tax Return, for the year in which that transfer occurred. Not filing that form when required is a reporting violation that carries its own penalty structure. But here is the part that makes this even more significant, and this is the part that almost no one explains clearly. When you gift property during your lifetime, the recipient receives your original cost basis, not the current market value. This is called carryover basis. But when someone inherits property at death, they receive what is called a stepped-up basis, meaning their basis is reset to the fair market value on the date of your death. The practical difference between those two outcomes can be enormous. If you purchased your home for $80,000 30 years ago and it is now worth $400,000, your child inheriting it at your death would receive a stepped-up basis of $400,000 and could sell it with little or no capital gains tax owed. But if you gifted them a 50% interest while you were alive, their basis on that half is only $40,000, your original cost for that portion. If they sell after your death, they could face capital gains tax on the difference between $40,000 and whatever the home is worth at that time. We are potentially talking about tens of thousands of dollars in completely unnecessary tax liability, created by a decision made with the best of intentions, but without complete information about the consequences. And the IRS is now identifying these unreported gift transfers by cross-referencing county deed records against Form 709 filing records. When a deed change appears in county records but no corresponding form was filed, the system flags it automatically. No human review required. Trigger 3. Rental income from your primary residence. This one has expanded significantly in recent years, and directly because of how easy platforms like Airbnb and VRBO have made it to rent out a room or your entire home while you travel. For seniors on fixed incomes, a few hundred extra dollars a month from renting a spare bedroom can be genuinely meaningful. It can mean the difference between covering your property taxes comfortably or falling behind on them. The appeal is completely understandable. But the moment you begin receiving rental income from any portion of your primary residence, you have changed the tax character of that portion from personal use to income-producing use. That carries specific and mandatory reporting requirements. The rental income must be reported on Schedule E of your tax return. Expenses must be properly allocated between personal use and rental use. And critically, you must account for depreciation on the rental portion of the home, which affects your cost basis and therefore how much taxable gain you will have when you eventually sell. Under current IRS rules, platforms like Airbnb and VRBO are required to issue Form 1099-K to any user who receives more than $600 in gross payments during the tax year. That form is sent simultaneously to you and to the IRS. So if you received rental income through one of these platforms and did not report it on your return, the IRS does not need to investigate or audit you to find out. They already have the data sitting in their system. Their matching technology compares the 1099-K against your filed return. When the income does not appear on Schedule E, the system generates a notice automatically. The most common notice is the CP2000, an automated underreporter notice. It is not technically an audit, but in terms of its financial impact, it carries similar weight because it is a computer-generated assessment that presumes you owe the tax on the unreported income plus interest, plus a potential accuracy penalty. And if you do not respond within 60 days, the proposed assessment becomes final. At that point, the IRS can begin collection actions, including filing a federal tax lien against your property. Trigger 4. The inherited property documentation gap. This one is perhaps the most difficult to navigate because it typically affects people who were in the middle of one of the most emotionally challenging experiences of their lives when the mistake was made. When you inherit property, whether it is your deceased spouse's share of the family home or a vacation property from a parent, the tax code provides one of its most valuable benefits, the stepped-up basis. Your cost basis in the inherited property is reset to the fair market value at the date of death, not what the original owner paid for it decades ago. This is enormously valuable. It can eliminate or dramatically reduce the capital gains tax you would otherwise owe if you later sell the property. But the stepped-up basis only works if it is properly documented. If the estate did not obtain a qualified appraisal at or near the date of death, if no Form 706 was filed for estates that met the filing threshold, if no records were created at the time of inheritance establishing what the fair market value was, then you are holding property with an undocumented basis. And under the IRS's current enforcement posture, an undocumented basis is treated as a zero basis until you can prove otherwise. That means if you sell an inherited property for $300,000 and cannot document what your stepped-up basis should have been, the IRS can assess capital gains tax as though your basis were zero. On $300,000 of recognized gain, that could produce a tax bill of $45,000 to $70,000 or more, depending on your income level and filing status. The IRS is now actively identifying inherited properties through estate filing records and probate court data, and matching them against subsequent sale records to determine whether proper basis documentation exists on file. How can they possibly know all of this? I understand the question forming in your mind. How could the IRS know you added your daughter to the deed 3 years ago? How could they know you rented your basement on Airbnb last summer? How could they know your mother's home was never properly appraised when she passed? The answer is what makes 2026 fundamentally different from every year before it. County recorder offices in most states now have active data sharing agreements with the IRS. When a deed is recorded, when a title is transferred, when a lien is filed, that information enters a federal database. Mortgage servicers report loan originations, outstanding balances, and interest payments directly. Title companies report closing transactions. Rental platforms report payment totals. Estate and probate courts report filings. All of it feeds into the same integrated system, and that system does not pause. It does not take weekends off. It processes millions of records simultaneously and never misses a match. It is running right now as you read this, comparing records, identifying gaps, and generating notices for the discrepancies it finds. 5 steps to take right now before May 19th. Sut. Step 1. Gather every document connected to your home going back to 2022. Start with your original purchase documents and the closing disclosure from when you bought the property. Then locate records of every significant improvement you have made: a new roof, a kitchen renovation, a bathroom addition, new windows, an HVAC replacement. Under IRS Publication 523, the cost of permanent improvements increases your cost basis, which directly reduces your taxable gain when you sell. Many seniors have invested tens of thousands of dollars improving their homes over decades but never maintained organized records. That missing documentation may be costing you real money. Then find any home equity loan or HELOC statements, the original loan agreement, annual statements, and anything showing what the funds were used for. Locate any deed or title documents reflecting ownership changes. And if you have been renting any portion of your home, pull your income records and platform statements. Step 2. Compare your last 3 filed tax returns against those documents. You do not need to be a tax professional to do this initial review. You are simply looking for things that do not line up. Did you take out a HELOC, but there is no mention of it on your return? Did you change your deed, but there is no Form 709 in your records? Did you receive rental income, but there is no Schedule E? Did you sell or transfer property, but there is no Form 8949 or Schedule D? You are not trying to solve the problem at this stage. You are simply determining whether a problem exists. Step 3. Bring what you found to a qualified tax professional. Specifically, you want a certified public accountant or an enrolled agent with direct experience in real estate taxation and IRS penalty procedures. You can locate enrolled agents through the National Association of Enrolled Agents. You can find CPAs through the American Institute of CPAs. When you call, ask one specific question. Do you have experience with IRS penalty abatement for real estate-related compliance issues? If the answer is yes, you have found the right person for this situation. Step 4. Create an account at IRS Gov and access your tax transcript. This is one of the most powerful and consistently underused tools available to any taxpayer, and it is completely free. Your transcript shows every return processed under your Social Security number, every notice or assessment that has been issued, and every piece of third-party data reported to the IRS matched to your account. Every 1099, every W-2, every 1099-K from rental platforms. Setting up the account takes approximately 15 minutes through a verification process called ID.me. Once you are in, you can see exactly what the IRS sees. If there are pending notices you are not yet aware of, they will be visible there. This is how you stop guessing and start knowing precisely where you stand. Shakyoy. Step 5. If you have received IRS notices you have not yet responded to, address them immediately. Every notice has a response deadline. If that deadline has not passed, respond before it does. If it has already passed, contact a qualified tax professional right away, because an unanswered notice does not simply disappear. It escalates through a predictable and increasingly serious progression. An unanswered CP2000 becomes a statutory notice of deficiency. That becomes a final assessment. A final assessment becomes a collection action. A collection action can become a federal tax lien recorded against your home. That entire progression can unfold over several months, but each step makes the situation more difficult and significantly more expensive to resolve. A critical warning about scammers. Every time there is a high-profile tax issue affecting seniors, fraudulent activity increases within days. And right now, that activity is already elevated. You will encounter individuals claiming to be IRS agents demanding immediate payment by phone, emails with official-looking IRS logos asking you to click a link to resolve an urgent matter, companies promising to make your tax problems disappear entirely in exchange for a large upfront fee. Here is what you need to know about how the real IRS operates. The IRS initiates contact through United States Postal Service mail, not phone calls, not emails, not text messages. They do not threaten arrest over the phone. They do not demand immediate payment in a single phone call. They do not accept gift cards, wire transfers, or cryptocurrency as payment under any circumstances. They do not send emails requesting your personal financial information. If anyone contacts you and creates a sense of urgency around immediate payment or personal information, it is fraudulent. End the call. Delete the message. Report it to the Federal Trade Commission at reportfraud.ftc.gov. The bottom line. The IRS has more data, more technology, and more enforcement capacity in 2026 than at any point in its entire history. Senior homeowners are being flagged at higher rates than any other group for unreported property-related transactions, and the window to come forward voluntarily and take advantage of the penalty relief provisions that are available to people who proactively address compliance issues is open right now. But that window narrows considerably after May 19th. The steps are clear. Gather your documents, compare them carefully against your filed returns. Consult a qualified tax professional who understands real estate taxation. Access your IRS transcript and see exactly what they see. Respond to any outstanding notices immediately before they escalate into something far more serious and far more expensive. Most people who find themselves in this situation did not create it intentionally. They made perfectly reasonable, sensible decisions about their homes without anyone explaining the tax consequences involved. That is completely understandable. But understanding how it happened does not change what needs to happen next. What changes your outcome is action. Informed, timely, specific action taken before the deadline passes. If this gave you clarity on something you needed to understand, share it with anyone over 60 who owns a home. That one share could genuinely save someone thousands of dollars and months of unnecessary stress. Subscribe so you receive these updates throughout 2026 as the situation continues to develop, and drop your specific questions in the comments below. Your situation could become the subject of the next video. I will see you in the next one.